I'd like to go ahead and welcome our next panel up to the stage, panel one. We're delighted. Thank you first, Yelena, so much for that wonderful introduction and talking about our federal regulatory system and how we can bring more financial inclusion to it. It's now my pleasure to introduce our moderator for panel one. Lydia Beyoud is a Fintech and Regtech reporter for Bloomberg Law. I'm also excited to introduce another Lydia. I'd claim actually the first financial technology innovation, not banking innovation, was the coins. And so Lydian coins were the first coins in Europe, so I think it's kind of cool. So, anyway, Lydia, off to you.
Thank you, Lydia. All Lydias know this story about the invention of coins. So I'm pleased to welcome our panelists. Joining me is Barry Wittes, Deputy Comptroller of Community Affairs at the Office of the Comptroller of the Currency. Then we have Todd Zywicki, George Mason University professor at the Antonin Scalia Law School. He's also a senior fellow here at Cato. Jotaka Eaddy, who's the Vice President of Policy, Strategic Engagement, and Impact at LendUp, and Tom Brown, a partner with Paul Hastings in San Francisco. So I'd like to actually key off some points that the chairman raised in her remarks for our discussion on how credit is reaching underserved communities. And that's kind of this notion of financial inclusion not being an amorphous concept, but sometimes the individuals that we think about in terms of extending financial inclusion to can sometimes be an amorphous concept. So I'd like to start with you, Jotaka. What is your definition of underbanked, unbanked populations, and how is LendUp working to reach them?
Well, thank you for that question. It's really great to be here and really appreciated the chairman's comments. When we think about or we hear the word unbanked, underbanked, what comes to mind for me is just the vast majority of Americans. It's it's our teachers that are teaching our children. It's our city workers. It's the vast majority of Americans. I think we all know the statistics that 56% of Americans have been shut out of traditional banking. We know that nearly 40% of Americans don't have access to funds or have access to $400 if there was an emergency. And we know that those numbers and statistics are growing. And it's an unfortunate reality. But for LendUp, our focus is on that 56%, really focused on developing and building transparent credit products, personal loans for those customers, but with the goal of ensuring that our business priorities are aligned with that of our customers' success, and by adding financial education and financial literacy, but also fundamental tools that the customers actually need, whether it's clear and transparent terms, access to instant decisioning, and where possible, cash pickup, another flexibility for the customer, 24-hour mobile access, that our goal is to ensure that the customer has the safe credit that they need, but an opportunity to build their financial wellness over time.
Barry, does the government, does the OCC have a different view of, or a similar view of unbanked and underbanked communities?
Well, we also want to encourage banks to be involved in mainstreaming, particularly people that were not gaining full access to financial services in the mainstream into banks. The area that we want to talk about today is the ability to use small dollar loans that people are using payday lenders for now. The OCC issued some principles-based guidance last May, a year ago, May 18, that encourages banks to get more involved in providing affordably priced loans of greater than 45 days that can be repaid in installments, that's friendly to people that have thin files and does not get them trapped into a cycle of debt, and on rates and terms that are reasonably related to the bank's costs. So we have put out that guidance, had conversations with a number of banks over the last 12 months since we put out that guidance. At least one major U.S. bank has a product that is geared to that clientele, that is picking up people that had previously been using payday loans within that bank. And we're hoping that more banks will pick up products like this. The issue right now is that the CFPB had guidance out that it's delayed dealing with the under 45-day market, which our policy does not specifically address, in part because that CFPB policy at the time was going to take effect this year. Now that that has been delayed, and as a result of our looking at some of the materials that we received and reading the FDIC's request for information about small dollar loans, there's an effort underway now to look at whether the regulatory agencies could issue additional guidance concerning that market. So it's an area that the OCC very much is encouraging banks to get involved in, and more broadly in terms of mainstreaming the unbanked into the financial system. That's always been a very significant goal of the Community Reinvestment Act, which we're in the process of looking at possibly modernizing, but the goal of increasing financial inclusion is very much at the heart of what we're trying to do in terms of CRA modernization.
Do you have a sense of timeline on either of those regulatory efforts?
I can say that on the CRA, we've begun a process. We issued an advance notice of proposed rulemaking in August of 2018. We've used the last several months since the comment period closed in December to look at those comments, to begin a conversation with the FDIC and the Federal Reserve. And I think the hope is to get something out this year, but I really can't be more specific in terms of the timing. And I would say the only thing for anybody in this audience or who's watching online is that they can get on the OCC's listserv, and all of our bulletins, our pronouncements, our regulatory proposals all will receive in their email as soon as they come out.
All right, well, Tom, I'm going to turn to you. You work with a lot of startups. Where do you see innovation happening in the banking system or outside of it?
It's a great question. And generally speaking, by virtue of our regulatory framework, it has to happen in both places. Because as a practical matter, you cannot offer a financial services product in the United States without connecting to the banking system. And in some ways, the whole setup of this stage and one of the rules that we all sort of came into the room, I don't know if you saw the sign outside. I just sort of noticed this. It said no food and drink. So how many people threw away their coffee before they came in? Yeah, not everybody, because I see some cups on the ground, okay? I'm not gonna call you out. But so then when you look up on the stage, right, like all the speakers get water. Right? Like that seems super unfair, right? So this actually turns out to be a wonderful sort of illustration of how the regulatory framework for banking works in the United States. Like the only way that you can move money is to go to a bank. And our whole regulatory framework is designed to send people who want financial services to banks. Just like if you need a drink, you have to come up here and ask me for it. I promise, no matter how desperate you are, I will not extract the maximum amount that I could from you. You will not get a similar commitment from a chartered financial institution. And that strikes me as a major problem, that we have regulatory barriers that are designed to reinforce a publicly granted monopoly. And so people like me spend a lot of time looking for places to innovate in white space and gray space on the regulatory roadmap. But as a practical matter, if you can't get a bank account, you can't offer those products.
So you talk about innovation that has to happen in both these sectors, but are you seeing any actual examples that are working?
Yeah, I mean, I can see examples on both sides. I mean, I think under the prior administration and continuing under the current administration, there have been efforts on the part of regulators like the OCC, the FDIC, the CFPB to encourage financial institutions to open themselves up to practices that were discouraged in the past. So Dan Kwan is here, who ran Project Catalyst for the CFPB and was instrumental in helping Upstart ultimately get through the no action letter process and receive permission to incorporate new types of data into an underwriting model. I think that's a wonderful, and to this point, the only successful example over the course of the last decade of the incorporation of something truly innovative into into mainline banking product, because those products are underwritten and offered by a bank. And then there are lots and lots of examples of companies finding ways to meet the needs of consumers for access to short-term liquidity, and to do so in ways that are consistent with those consumers' interests. So products that are offered on a non-recourse, no-fee basis. And again, the CFPB was sort of instrumental in creating white space for those products by carving them out from their payday rule. I think what's somewhat frustrating currently is that we don't have sufficient consensus across the policy space or across the political landscape to embrace what seems obviously good. And so every couple of years, we sort of have to reboot and have the same conversations over and over again.
Well, on the notion of having the same conversation over and over again, Todd, can you comment a little bit on can you tee off of what Tom said about navigating the regulatory structures, both kind of in the panoply of federal regulators, but also with the states, and what sort of economic impact does that have on startups or even larger institutions?
Yeah, and more generally on financial inclusion, I think. And to my mind, financial inclusion is really a moral imperative, which is getting people access to financial products, as Tom just said, it's like the key to the good life, right? I mean, a bank account, a home, a car loan, basically everything you need. You got to have access to funds, right? And it's basically the launch pad for everything. And what I think is unfortunate, especially in the wake of the financial crisis, we just passed a bunch of laws and regulations that were devastating to financial inclusion. First, there was the Credit Card Act, and the Credit Card Act, Jamie Dimon said, for example, that 15% of their customers would have to be dropped because the Credit Card Act made it more difficult to price risk. The lowest quartile of households, credit card ownership dropped by 11 percentage points. Meanwhile, high-income households were completely unaffected, right? They weren't affected by the effects of the Credit Card Act. And then you get the Durbin Amendment, which is, I think, a complete disgrace. The Durbin Amendment placed price controls on interchange fees, free checking, which had exploded as debit cards came into greater use, was cut in half by one estimate, larger amounts by other estimates. Bank fees on those who lost free checking were doubled. And that drove a lot of people out of the banking system, and they ended up using things like greater reliance on payday loans, auto title loans, and that sort of thing. And the response to that was their life raft, so let's start shooting holes in the life raft, right? And let's outlaw payday loans and auto title loans. It's completely outrageous how Washington has pummeled low-income consumers, driven them out of the financial crisis, and now the next scheme is let's double down on it and bring back usury ceilings, right? And we know usury ceilings we know who they're going to hurt the most. I mean, literally hurt. I did a column last week, you may have seen in Real Clear Politics, back in the day of usury ceilings when when only about 15% of households had credit cards and small dollar loans were unavailable. The loan sharking market in the United States was estimated at about $10 billion, which is about $69 billion in today's dollars. To give you a sense, that's about double the size of the entire payday loan market in the United States. These people were breaking legs. One loan shark said, here's what I do, is I clip the top of their ear and I say, are you going to pay up? If not, I'm going to take that ear. Tomorrow I'm coming back for the other ear, and then I'm going to start taking fingers, right? And the response was, let's call usury ceilings the Loan Shark Prevention Act, right? As if what's going on in the financial system today is the same as cutting people's ears off in their fingers, right? So I think it's time to get serious about this. I think it's time to start adopting policies that treat low-income people as valuable customers, as people banks want to serve by giving them incentives to do it. And let's start thinking more about innovation. Let's talk about the things that Tom is doing in terms of serving under the developed markets with respect to fintech. But let's also revisit the idea of giving Walmart a bank charter, right? Walmart gave up 10 years ago because the incumbent banks basically blocked Walmart from getting a bank charter. Instead, what's the response now? Postal banking, right? We're going to basically take low-income consumers while the rest of us get FedEx banking. Low-income consumers, we're going to herd into this new regulated public utility system, and they're going to get payments from the post office. And I just think it's time to stop treating people who don't have a lot of money as second-class citizens just because they can't navigate the regulatory system like the rest of us who have done quite fine over the past 10 or 20 years with respect to banking innovation and the like. So let's look at the incentives. Let's look at the people who know what they're doing, like Walmart, and give them an opportunity to start serving this. And let's get out of the way of startups who can provide new products to new people in a productive way.
Well, Jotaka, I want to get your perspective too on navigating the regulatory structures at the state and federal, because you've had to do that. What's been your experience, and kind of where do you see either improvements or opportunities for improvements for kind of balancing consumer protection, but also helping you guys innovate, but also and be successful, but achieve the goal of actually helping bring people into mainstream financial system?
Well, I think LendUp's experience is much like most fintech startups. It's a very vast, regulated landscape. And for LendUp, we operate on a state license model. So we are licensed in the states in which we operate, individual licenses for our states in which we operate, but also we are regulated by, of course, the CFPB, and then there are other regulators in which we interface with. And so it's, I think there's a real opportunity for more streamlined communication. I think it's very helpful to see, where state regulators are beginning to come together to think about streamlining everything from the process of even just getting your license to the rules that are set in place for how you operate. Because if you operate in California and you operate in Texas, you're operating under two different sets of a regulatory framework as it relates to the operation specifically for that state. I do think it's helpful to see the CFPB and just some of the work to create a more broad framework. I think, as Barry shared, there has been some rulemaking that has created opportunity to just really streamline and have a roadmap for operating. Of course, we are all waiting on the finalization of those rules, but I do think, and I think now you're seeing in Congress, there's a lot of conversation about fintech. I think there's a great opportunity. Listening to the chairman's comments and just thinking about my own personal story of, graduating college, having very low credit, having, no access, being denied for an apartment when I first moved, actually an apartment just down the street here, and what that felt like, and having a drastic change in my credit score and having access. And John Hope Bryan, who I think many of you may have heard of, he has this saying that says, there's nothing that will change your life like the love of God or whomever it is you serve in a 100-point increase in your credit score. And that's absolutely true. I've lived it, and I see it. And then I think about LendUp's customers. We ask our customers, and just a bit about our customers, the average credit score of a LendUp customer is 550. 98.5% of our customers do not have access to a rewards card. But our customers are customers who are in need of credit. 70% of them deal with income volatility. They've shared with us that on a month-to-month basis, their income is fluctuating by $100 to $200 a month. But these customers are also customers that deeply want to increase their financial health. We asked our customers, would you rather have a $100 or a 50-point increase in your credit score? 90% of our customers say they would rather have a 50-point increase in their credit score. 70% of our customers share with us that they check their credit score at least once a month. 70% of our customers make plans for savings. But the reality of both income volatility and income shocks prevent them from being able to realize some of the goals around savings, and they also have an incredibly hard time accessing the credit. So there's a real need and a real opportunity for technology and fintech to really service a gap that's in the community. But I do think that there's also an opportunity for the regulatory environment to catch up with where the promise and opportunity of technology is.
And how difficult is it for consumers who are, using your product or using another non-bank product to actually reach that, 100-point increase in their credit score? How long does that take? Kind of how do they go about doing it?
Well, of course, because of how credit scores work in our country, there's a lot of factors that impact your credit score. LendUp, we did a study with TransUnion, and our study showed that customers who have that have been with LendUp for at least 2 years show, on average, they have a 62% likelihood of a 50-point increase in their credit score. And so it takes time, but for LendUp, and it's not just LendUp, it's also other fintech companies that are out there that are particularly focused on financial health. I think the importance is really education, coupled with access to credit, in addition to looking at behavioral economics and just-in-time education. So what type of tools and what can you put in the actual product that will actually help the customer make better decisions? And so there are things that, I think if I polled this room and asked, what are the 2 most important factors in your credit score? I'm not sure if everybody in this room would know that, 2 very important factors. I'm sure you will know, but 2 important factors is, on-time payments and credit utilization. Are you utilizing more than 30%? And this is information that's impacting people's credit scores and driving us to a point where 56% of Americans and people in this country have a credit score below 680. And as a result, there have been studies. If your credit score is below 680, there's a likelihood that you will spend $250,000 in additional fees and interest over your lifetime. I'm from a tiny town in South Carolina with 1 red light. $250,000 could purchase about 6 or 7 homes where I'm from. That's a lot of money that is leaving our communities. That's a lot of economic drain. And there's a real opportunity and need to enable technology and financial services, both inside the banks and outside the banks, to innovate in a way that we can meet these customers where they are.
Barry, I want to turn to you. About roughly a year ago, the OCC put out, said it was going to make this a new bank charter, a type of bank charter available to fintechs and non-banks. We haven't seen anyone come forward. There's some litigation over that, but it does kind of go into the notion that the chairman also spoke about in terms of bringing in new entrants into the banking system. You've also had a couple of fintechs who have applied for regular banking charters. Can you give us an update on kind of the OCC's view of that sort of activity and encouraging some new entrants into this space, and how, what's the view for how that might achieve some goals towards financial inclusion?
Well, as you said, the policy came out about a year ago. We have had discussions with many firms that are considering what is called the Special Purpose National Bank Charter, which would be essentially a non-deposit taking bank. Some of these fintechs that have come, that are evolving, are not interested in a brick and mortar infrastructure, an expensive brick and mortar infrastructure. Instead, are looking to take deposits through the internet, through mobile banking, and so forth. So, in order to enable them to offer products in the environment which they're most comfortable, which is online, without a brick and mortar deposit-taking infrastructure, that's why we've put out policy guidance to allow these firms to come in and seek a charter without having a deposit-taking footprint or base of customers. We've had litigation. It's been litigation from some of the states that have challenged our ability to do this. But nonetheless, we have had a couple firms that have come in and decided that they're going to seek a charter, do a fintech model, and take deposits, and thus go through the normal process of getting deposit insurance from the FDIC. In terms of how that facilitates financial inclusion, having these types of firms more active in the banking system, well, first of all, there's lower costs. So just the sense that they can offer a product without having a very expensive brick and mortar infrastructure is significant. But also to the point that they are more interested in using non-traditional models for evaluating borrower credit capacity, looking at factors like borrower cash flow in and out of their checking account is one model for evaluating somebody who does not have current credit to get credit. I mean, a very significant number of households, CFPB said maybe 25 to 30 million households don't have credit because they're thin file. They just don't have a credit history. A recent immigrant to the United States does not have a credit profile here in the US. And so, you know, it's a little bit of a catch-22. Well, how do you get a credit profile? Well, you get a credit card. Well, how do you get a credit card? Well, you know, it's that catch-22. But to the extent that they can establish their ability to manage money through ins and outs of their checking account, and I believe you'll hear from speakers later today that will go into more detail how that type of approach is becoming more prominent in the financial services sector. But it's models like that that some of the newer firms are looking to employ. And then the other thing that's happening is that some of the fintechs, like LendUp, are beginning to approach banks and saying, well, we already have a model. We're using these non-traditional factors that we've been able to validate through our portfolio over the last few years. Is there a way that that entity can partner with the bank? So it might be a bank offering that fintech's model on the bank's platform. Maybe the customer doesn't even know that the bank is using the back office of a LendUp or a firm like that to underwrite and offer these loans to their customers. Another model is where a firm like LendUp might accumulate a portfolio of loans that it's made and sell that portfolio to a bank. Bank is looking for an earning asset. The bank has the ability to service the loans. And a company like LendUp that is in a growth phase and is looking to maximize its ability to serve new customers might see as an advantage to be able to sell a portfolio to a bank. And so we're beginning to see these types of partnerships occurring. And so I'm very encouraged that as a result of the OCC really getting very interested and actively involved in financial innovation, we created an Office of Innovation. We have a Chief Innovation Officer, Beth Knickerbocker, and I serve on the agency's Responsible Innovation Committee. We put out a policy for comment recently that would allow banks to come in and seek our guidance on new approaches for offering innovative financial services that the banks have questions about, whether it comports with current reg and policy. And so a lot of these new models, these new approaches are a little bit different than we've had traditionally, but we want to be responsive to the changes in the market and see how we can accommodate. So I think all of these things combined with our effort to try to charter a fintech bank, I think really demonstrate an interest by our agency to facilitate financial inclusion and to facilitate new models of reaching customers that aren't currently well served by banks.
Well, we've got a few minutes before we open it up to Q&A, but Tom, I guess, what's your response to kind of the laundry list of initiatives that the OCC and also the FDIC mentioned in terms of chartering new entrants into financial services? Is that actually going to benefit consumers? What's your sense?
Well, I can promise you that it's going to take a lot longer for the OCC and the FDIC to realize the articulated plans than we have time left to talk about them. We've been hearing about the possible resurrection of ILCs or the special purpose bank.
Can you explain what an ILC is for folks who might not know?
Sure. So an ILC is an industrial loan corporation. It is a financial institution that can make loans. There are 3 states in the union that recognize and charter ILCs. Those are Utah, Nevada, and California historically. Only Utah at the moment is sort of truly offering the non-Bank Holding Company Act version of an ILC. They're controversial because they represent, is anyone here familiar with Glass-Steagall? Is this a thing that people in DC? Yeah. So ILCs have historically not been popular because they allow businesses that engage in what we would traditionally define as commerce to also engage in certain kinds of banking services, not taking consumer deposits, but making loans and large deposits and commercial deposits. Historically, they have proved to be fairly volatile institutions because of the somewhat limited nature of their operation, and all of the banking agencies at one time or another have said that they don't like ILCs. Like it's just I find it to be like this remarkable, just a super funny thing. I mean, I don't often get sort of dumbstruck, as it were, but I notwithstanding the current sort of fascination with ILCs, I just don't see ILCs sort of A, emerging, or B, proving a vehicle for reinvention of financial services in the United States.
But it's worth noting that Square has applied for an ILC for its lending to small businesses.
And they've been waiting 2 years, and Vero has applied for a traditional OCC charter, and I think I saw Colin running around the mall this morning. His beard has gotten much longer since he started that epic trek. So we're just notwithstanding the talk in this room, we don't have sufficient political consensus to allow any of these things to happen.
Todd, you're obviously an ILC proponent. Where do you see chartering new institutions fitting into financial inclusion?
Yeah, well, I mean, everybody laughed when you said that the traditional banking regulators doesn't like ILCs, right? And obviously, traditional banks don't like competition either, and they're pretty darn good at keeping competition out, just like they did with Walmart, 10 years ago. Right. So I think it's always going to be the incumbents are very politically powerful. The great legacy of Dodd-Frank, of course, is that it's made too big to fail institutions even bigger and more too big to fail. It's increased concentration in basically every single market that it has done. It is not a single person in America thinks that Dodd-Frank got rid of too big to fail, as far as I can tell. And so it's just kind of, and it's crushed small banks, and it's increased, I think, the clout at keeping out these rivals. And one thing I also want to say about this, and this picks up on your remarks, is there's a sort of a lag to this also, which is not good, which is traditionally young people have been a group of people who lack access to a lot of financial products. And what we've been seeing over the last few years is that young people are financially maturing later in life than they did in the past, right? So the credit, it makes it, various regulations make it harder for a college student, for example, to get their own credit card, right? The debt overhang of student loans is making it much more difficult to qualify for mortgages under the one-size-fits-all underwriting standards of Dodd-Frank. So what you're causing students, people, instead of starting to get access to credit cards and mortgages and car loans in their 20s, all that's being pushed off, right? So you talk about people with thin files, you talk about people who don't have proven credit histories. A lot of these regulations and, independently, the whole student loan fiasco is perpetuating and perhaps, increasing the problem that we've been talking about. Fortunately, those are exactly the same people who are going to probably be most savvy and most comfortable with turning to alternative providers if we can get the banks out of the way from blocking these guys in rent seeking and allow these different products to actually proliferate and compete against them.
I'll just make one point. Vero, which actually was mentioned a moment ago, has conditional commitment from the OCC. We work with that applicant to get approval, and now it's a two-step process. If you choose to go with a bank charter that is deposit taking, then you have to get approval for deposit insurance. If Arrow had sought a special purpose national bank charter without the deposit insurance, then it's only one approval that's needed. But if you choose to go for a charter with deposit insurance, then the chartering entity, in this case the OCC, approves it, and then the FDIC has to approve it.
Right. So we're going to open it up to questions. I see there are a few hands raised, so I'm going to call on a couple of you at once. Why don't we start with the gentleman in the middle and the woman over here on my left? Whoever gets the mic first. Now, there's the guy in the middle, and she's right there next to you. And if you could please be sure, okay, well, I meant the other guy, but we'll get to you. If you could please be sure and mention your name, who you're with, and make sure it's a question. Go ahead.
That's pretty challenging. Warren Coates, retired from the International Monetary Fund. First of all, I'd like to thank everyone for a very stimulating and generally optimistic presentation. But there's an elephant in the room that's had a very negative impact on financial inclusion no one has mentioned, which is anti-money laundering and CFT regulations. And I think OCC is responsible for guidance on de-risking that had a devastating effect around the world of a lot of poorer countries and so on. The IMF undertook a study a few years back to quantify the costs of all this, which are enormous. The report said they were unable to identify any benefits. Comments, please.
Well, as with any regulatory regime, right, it's frequently easy to identify costs, less obvious where the benefits are. I would certainly agree that the existing regime, and this is an issue that we spend a lot of time helping folks with at my law firm, the existing regime for money laundering and foreign sanctions is process and cost intensive, and that there would seem to be better ways to do it. With that said, having worked in that space, and if you talk to the current Assistant Secretary of the Treasury who's responsible for those issues, there's no question but that the money laundering regime does help prevent terrorism, money laundering, organized crime, human trafficking. We can attempt to better quantify those benefits, but there's really no question that the regime and FATF have helped to combat and reduce criminal activity around the world.
I mean, the only comment I would make is that we have tried to institute measures to provide customers the opportunity for alternative means of providing an identification to open up a checking or savings account. And so, I think that over time has helped to facilitate financial inclusion by most Americans that seek to open a checking account, to the extent that, some of the issues you raise regarding remittances overseas and the like, get to the issues that were mentioned in terms of trying to prevent terrorism and so forth. But in terms of the vast majority of Americans that just want to get a foothold in the financial system, we have taken a number of steps to make it so that alternative means of providing identification are available to at least open that account. And then in terms of, remitting money overseas, we do have rules, and we expect those rules to be followed. And we do expect to have some level of understanding of who's receiving those monies on the other end. But I don't think that is a major hurdle to financial inclusion for most Americans.
Let's go to the gentlelady here.
Thank you. Very interesting. My name is Patrice Lyons. I'm General Counsel, Corporation for National Research Initiatives. You probably don't know it. It's in Reston, Virginia. But the principal and his former vice president brought you the internet, the TCP/IP, and I've been counsel to them for all the years. My question and interest here, and it's one of the things I've worked on and written on, is that if you reconceptualize what it means to be, say, a loan or a bond or a security, and I think in some of the UNCITRAL work, they call it the dematerialization of, say, a security, where you get rid of the paper. What is a check? Check is usually tied to paper, but if you get rid of the paper and you represent it in digital form. And the ultimate one, the big one on the block, is what's money. I've been to World Bank conferences where some of the central bankers, say in Africa, say, well, money's money. And there's a whole system around that. So to what extent would the reconceptualization of these units that you'd be able to uniquely and persistently identify, and there's technology and standards that have been developed that I'm really involved in, called the digital entity, that you can then actually do business on those in digital form using, say, a laptop or a smartphone. It just revitalizes things. And I'm wondering if, say, in the OCC, in some of your Office of Innovation, if that's of interest.
Well, I mean, we're responsive to the banks that we supervise in terms of their interest in undertaking financial innovation that will help them better serve their markets. So if a bank came to us with a particular idea regarding digital money in some way, shape, or form, and there was a question about whether or not it was permitted or what the rules of the road were in terms of the regulation of national banks or federal savings associations, we'll engage in that conversation. And in fact, as I mentioned earlier, we have this pilot initiative that we've put out for public comment. So even if there was some uncertainty, but a bank said, well, we'd like to try this on a pilot basis, and it was consistent with US law and so forth, then that would be the kind of pilot that we potentially would consider if a bank came to us and said this is something we want to pursue. So to answer your question, we are open to ideas that banks bring to us in terms of how they can better serve their customers using financial technology.
So can I add? Yeah, so for what it's worth, the legal and regulatory issues associated with the full digitization of instruments, whether they're cash, securities, or bonds, is actually quite complicated. I mean, the UCC does actually contemplate physical instruments. Our rules related to custody contemplate physical instruments. I think it would actually be helpful for, and I don't encourage this often, right? Having spent time sitting through Uniform Law Commission convocations on various topics, I actually do think it would be useful for the ULC to commission a digital UCC 2, which is the article that sort of supports our entire securitization and lending industry. If Todd would agree to be the reporter, I might even agree to participate again.
I mean, that blockchain is being used on a test basis by a number of actors to do the kinds of transactions that you're talking about. So there is definitely some work being done in that space. On some banks that we supervise are involved with various types of pilots and initiatives to do the kinds of things that you're talking about. So I think our role as a regulator is as banks come to us with these ideas to try to work with them. As I said, we have this Office of Innovation. I sit on the agency's Responsible Innovation Committee. And we have a lot of meetings and look at a lot of things, and we're formalizing it through this pilot process.
All right. Unfortunately, we're out of time. I'm sorry if you didn't get your question asked. Hopefully you can try and find some of our panelists later. Thank you all, and thank you to our panelists.